All right, welcome everybody to JNS Capital First Interview. I'm going to be your host, Sean Sharabi, and I'm super pumped to be interviewing my very own partner, John Davenport. We wanted to do the first interview in this manner and take some time to give people a better understanding of what goes on in John's brain, what he's been up to the past couple years. And really, it's easy to consume stuff written at times, but I think also giving an audio version helps people understand it a little bit more and really helps piece together some of this information. So John, welcome. I really want to kick things off with a few toss-ups and then hopefully get into some things that can stump you a little bit. But to start us off, can you maybe just give us a little bit of your background? Tell us where you're from, where you went to college, and kind of a little bit of your career leading up to us launching JNS Capital.
Yeah, man. So I grew up in California, a little bit south of LA. I was a golfer. I played competitively in high school. I was fortunate enough to get recruited to play in college. I ended up at Columbia in New York City. Quickly realized I wasn't going to be a professional golfer. So I decided I better get good grades, and I suppose it's kind of the rite of passage as a New York City college student to go get a job on Wall Street.
Yep,
Classic. And so while most people were going for that investment banking job, I did things a little differently. I joined a startup credit fund at the Royal Bank of Canada. When I got there, it was me, four other people, $0 in AUM. And by the time I left, it was me, four other people, and about $1 billion in AUM. So it was a really small team. We had a lot of work between the five of us. And
Yep.
I got hired initially to kind of, to be the grunt. I was doing a lot of the analyst work, and I didn't really want to do that. I wanted to be investing. I wanted to be somebody who was in the game. I always kind of felt like I was in the sidelines, and so I spent pretty much all of my free time at the office, at home, just studying, learning everything I could, really just trying to prove to my portfolio managers that maybe they could trust me with a little bit of the book. And fortunately, I don't know whether they saw something in me or they wanted to pass off some work, but they spent a lot of time training me, mentoring me. And, after I'd done enough deals with them, they gave me my first coverage. And, let's be honest, it was the one that nobody else wanted to do. But from there, it just expanded and expanded. And eventually I had about $150 million of our book under my coverage, which, as a 23-year-old was a very interesting, unique opportunity.
Yeah. And at this time, were you like were you in this phase of like you were confident with what you were doing, your strategy, your approach, or did you feel like you were in a little over your head?
Totally felt like I was in over my head, at least at first. I mean, it was trial by fire. It was, look at this company, figure it out, tell me whether or not you want to buy it. And I mean, as a 23-year-old, when they're like, okay, should we put 10, 20, $30 million into this? And, whether I said yes or no was pretty much the final answer. It was terrifying, but that made me work harder. That made me learn more. That made me get confident in what I was doing, because I didn't want to feel like I was faking it. I wanted to feel like I knew what I was doing. I wanted to feel like, when I was presenting something to my PMs, that I knew what I was talking about, and, I was an authority over those names. And, by the end of it, I felt like I knew what I was doing. I don't think we ever actually lost money on any of my investments. So I would say that's a success.
That's a win.
But that experience really kind of ignited my interest in investing. I'd done it before, just like everybody else, but I never really knew what I was doing. It was more like, okay, this company seems cool and they seem like they're growing. I'll buy the stock. So there wasn't any rhyme or reason to what I was doing, but starting off specifically in the credit world, I think was a huge advantage to me, because it really forces you to really study the companies for what they are, to really get into the business models, get down, learn the fundamentals, figure out what makes them earn money, what makes them generate cash flow, how they can stop, what are the problems, what what's my asset coverage? What do they own? Like, what's on the balance sheet? So
Right.
there's a lot of stuff that goes into credit that you may not really pay attention to in the equity markets when all you're thinking about is, oh, how high can this stock go? And that's kind of the experience a lot of junior analysts get in the credit in the equity market. It's like, oh, is revenue growing? Is it going to keep growing? And it's, that's not really how you look at a company. You want to figure out what makes the company work. What is, how much money are they making? How much money are you as the owner going to get? Or in my case, in the credit world, am I going to be able to get paid back? Mm-hmm. Are they going to be able to refi? And, if they don't, like, what am I going to get? What's on the, what am I going to be able to recover from the company? What is the true underlying equity there? And that's what do they own on the asset side? What do they owe on the liability side? Mm-hmm. And what's left? So it makes you really learn how to look at a company, how to analyze a company. And so that was,
I feel like that also, like, that coming from kind of starting things from that perspective where that's like, because as you're saying, it's not like you knew you wanted to be an investor from childhood, right? So like your first sort of main focus being from that perspective and being hyper focused on like I would say a pretty conservative outlook and pretty conservative like start from investing was by very influential and caused a very different sort of way of thinking than somebody that starts from a totally different place as an investor, right? And I imagine that's largely why it's led, what we're doing, the strategy that we're taking has a lot of the strategies that we have because sort of coming from that conservative place, right?
Totally. I mean, it completely influenced the way that I invest today. And again, in the credit world, the only thing you really care about is downside, right? Again, it's, am I going to get paid back? If I don't get paid back, how much am I going to recover? And that's it. You don't really care how much revenue grows other than to the extent it helps you get paid back. So it's completely downside oriented. And that's really how I think it makes sense to look at the equity market as well. I don't care if a stock is going to go up 50% if I'm going to lose 80% in a downside scenario, right? Like, that's not how you make money. You don't lose money by making 50% and then losing 80% and then making 50% and losing 80%. You make money by making 50%, and when you lose 10%, or you lose nothing. Or even if things don't go your way, you're buying things that are so cheap that you still make money. So really, the way that I look at the equity markets is, okay, let's just make sure that, first things first, if things don't go the way that I want, I want to make sure that I'm either not losing money or I'm losing very little. And, the good thing about that is, by nature, you're buying things that are so cheap that there's also a ton of upside if things do go well. So you're getting these, low downside but high upside scenarios. You're buying things that are priced as if things are going to go poorly. So if things go poorly, you do fine. They're already priced for it. But if things do well, you make a ton of money. And over the long term, that's how you grow your portfolio, grow your assets, make money while also never, not having that big blow up that permanently takes you out of the game.
Right. And as you got going, at what point did you start to really get engulfed in kind of studying different investment philosophies, strategies, and so on? Was it pretty early on at RBC or?
Yeah, from day one. I mean, I'm an incredibly competitive person by nature, and as soon as I started to actually have control over money myself, I needed to try to be the best at it, which meant studying everything. From the equity side, credit side, you name it, reading about every successful investor I could possibly read about, studying everyone, learning from all of them, taking little bits and pieces and kind of incorporating them into something that works for me, because every investor is different, right? Like, you can have 100 different investors that all make money, and they all are going to do things slightly differently. Generally, everybody shares at least one aspect, which is buying things for cheaper than they're worth. But how they go about that can be completely different, and that's dependent on the investor's disposition, yep, what they're interested in, what motivates them. It's just you have to make things your own. But yeah, from pretty much from the second that I started working at RBC, I was a sponge, man. I was learning. I was reading, listening to podcasts while I'm walking to work, on the subway, listening to audiobooks in the gym. Basically, my entire life revolved around trying to be as good of an investor as I possibly could. And, I took that, and after 2.5 years at RBC, I decided I wanted to see some other areas of the investing world. And so I hopped to a private credit firm, and mainly what we were doing there was asset-based lending. So we were providing loans based on the asset value of ships, of portfolios of consumer loans, of real estate, of Picasso paintings. I mean, you name it. And that was another incredibly interesting opportunity. Unfortunately, it got cut a little bit short by COVID, but that, because the entire industry shut down, and then I had an opportunity that I couldn't pass up. I had been developing a little trading strategy on the side due to not having the same trading restrictions at the private credit firm as I did at RBC. And the intention with that was originally just to make a little bit of side money, and with the hope that eventually it would let me go off on my own and do something for myself. I always kind of figured that I was gonna work for myself. And that was always a goal of mine. And to very simplistically describe the strategy, is it was basically a market making algorithm. And so when COVID shut down and we experienced 2020, 2021, 2022 in the markets, which was basically just characterized by unheard of volume and unheard of volatility. And if you're a market maker, that's exactly what you look for. And within a month of COVID, I was already making multiples of my salary, essentially just trading my first 2 bonuses. And so I left my job and I decided to try to do that full time.
That was like, that is, so maybe talk a little bit on the getting into that and how different, well, tell us a little bit about like what that looked like, right? What was the actual maybe day-to-day, week-to-week look like, and how different is that from much of the like investing principles that like obviously we're deploying today, and that you're kind of studying? If you can talk about those two things.
It's basically the opposite. What we're doing now is much more long-term. We're taking 1 to 3 to indefinite timeline investment theses. We are learning about the fundamentals of a business. We are learning about the world. We're incorporating everything into, essentially trying to predict the future in a sense. Whereas this specific little trading strategy that I was doing was much more opportunistic. It was something that it was a little ripple in the market that I had noticed that I thought I could exploit, but it wasn't doing it wasn't doing rigorous analysis on any individual company. It was more like, hey, I have found this trade that I have a 2% advantage on, and it's successful 80% of the time, and I'm going to do this 1,000 times per day. And so it was incredibly short-term in nature. It was, it was basically an arbitrage trade in a sense, or, a partial arbitrage, I would say. But it wasn't intellectually interesting. It was a lot of just rote, plug and chug. Oh, I've identified these, various trades, and now I'm just going to execute them as many times as I can. It was more for me just a way to give myself a nest egg that would enable me to go off and do what I really wanted to do, which was invest my money on a much more long-term basis, take positions in individual companies, learn about the world, learn about industries, learn about companies, talk to experts, all the stuff that's, the interesting parts of investing. And it worked. I mean, I made about 7,000% on my trading capital, a bit more than that actually, over about 3 years. And at the same time, knowing that, well, one, I had a little bit of extra cash, a lot of extra cash actually, coming in from that trading strategy because it wasn't perfectly scalable. At a certain point, I had more money than I could run with this strategy. And so, that it combined with the fact that I knew that, I knew that I wanted to start my own fund at some point. I knew that I wanted to have an investment partnership. I didn't know exactly when that would be, but I had a sense that it was in the future, and so I needed to start developing a track record, and I needed to make money with the money that, I had sitting around. So I started an account to invest, really the same way that we invest now in our partnership. 1 to 3 year plus theses, deep value principles. I mean, taking positions in individual companies, and I wanted to do that to develop a track record, just so one day in the future, I could start my own thing and I could point to and be like, hey, look, I did this, we did well, whatever. And so
when was this that you started, that you, I mean, there's opening the actual, fund, taking in other money, but when would you say you started deploying to some degree this type of strategy?
Well, I'd been doing it since my RBC days, but when I really, did it much more intentionally, and that was about late June, early July 2020. So I'd been trading for about 3 months full time at that point, and I started to have some extra cash, and that's when I started doing that on the side. And I did really well. I mean, I think I did something like 25% over the next 3 years, and the S&P did something like 11% during that period. And some people in my network started to take notice, some high net worth guys who, I think probably saw a little bit of me, or a little bit of them in me, and, took an interest, and also I think thought that they could profit, and asked me if I'd run some of their money for them. And I just decided that was probably too good of an opportunity to pass up. I had to seize it. So I stopped trading. I opened up a partnership to invest my own money and the capital of a few people who trusted me with theirs. And I ran that for about 2 years. We did well. And ultimately, that's when I met you, and that's when we decided that we wanted to try to do something a little bit bigger. And here we are.
Yeah. Well, I'm going to back up a little bit. So I think a lot of what I've heard, getting to know you and some of what you're sharing now is this, and I think all entrepreneurs share this to some degree. It's that, go against the grain mentality. It's pushing against, what much of society tells us to do and we should do, and basically wanting to be that rebel. Did you always have that type of mentality in you from a young age, or did that kind of blossom later in life?
It's an interesting question. I wouldn't necessarily say that I have a go against the grain mentality. I think that implies that you're kind of doing what others aren't purely for the sake of doing what others aren't. Whereas I would almost describe it as, I'm always going to do what I think makes sense, regardless of what everybody else is doing. And in fairness, I think sometimes it makes a lot of sense to do what others are doing. All my friends went to college. Did I have a better opportunity than going to college when I was 18? Probably not. So I went to college. But then at the same time, there's a lot of situations where everybody seems to be losing their minds, or everybody seems to be doing something that doesn't quite make sense. And I've never really gotten swept up in the crowd like that. I've always kind of decided for myself what I should or shouldn't be doing. And I think that applies to life, and I think that applies to investing. I mean, when I left my job to trade full time, how do you think that was received by everybody else? I mean, everybody thought I was nuts, but I knew I was onto something, and so I did it anyway. And I think when you kind of bring that into, how we invest in the markets, I mean, we we have a pretty basic philosophy. I mean, we go through the opportunity set, we go through the market, we look at all the individual companies we can, we learn as much as we can about everything, and then we make a decision. If we think that we're able to buy something for less than it's worth, we do. If we don't think we can buy something for less than it's worth, then we don't. Where, and it seems so simple, but that's just not how people invest, which is, I've always thought, interesting. I mean, I think right I think right now is a pretty good example. I mean, we're probably in, we're in the biggest speculative growth bubble since 2000, at least, maybe ever. And how does that happen? Well, people see stocks going up, then they tell their friends, oh, look, this stock's going up. Then their friends tell their other friends, oh, look, this stock's going up. And everybody's hearing about all these people that are making so much money. And they're like, why am I not making money? I need to be in on this too. Yeah. So they're like, okay, let me go buy this, cryptocurrency that has a picture of a dog on it, because all my friends are buying this cryptocurrency that has a picture of a dog on it. Does it have any value? No, it has no value. It doesn't do anything, but people buy it because they think it's going to go up. And
I want to stop on this point for a second, because I think this, when you think of the greatest investors of all time, there's so much of the information and their strategies that are public to everyone and have been public to everyone for decades. And what we're doing isn't this revolutionary, unique thing that no one else is doing. What many of the greats have done, it's kind of the same. So what, I'd love to hear, maybe highlight some of the most influential investors that you've sort of taken, maybe one or two of their main strategies into how you think about things. And then B, I'd love to hear your perspective on why you think people, know the things you should and shouldn't do, yet why isn't everybody, why aren't more people beating the market? I'd love to hear that from you.
Well, I mean, it's hard to narrow it down to just a few people. I mean, I've studied hundreds of investors, and I've probably taken parts of everybody and used that for myself. I think if I had to kind of narrow down what who are the most relevant to the exact strategy that we're doing today, I mean, I think the obvious one is someone like Benjamin Graham. I mean, he's kind of known as the father of value investing. And basically his whole premise was, again, buy things for significantly lower than they're worth. Because if you're buying things for significantly lower than they're worth, that's the margin of safety that everyone talks about, then there's a lot of wiggle room for things to, not go as planned, or to have some bad luck, or, any unforeseen thing that you can't predict everything that's going to happen. So there's always going to be things that pop up, some good, some bad. And if you're buying something for, 50% of what it's worth, let's say, then a lot of stuff can go bad before you lose money. And on the other end of the spectrum, when people start to actually realize what it's worth, you make a bunch of money. Or let's say that you're overly pessimistic in your assumptions and you get some good luck and things go much better than you think, then you crush it. So I think that's that's kind of like the fundamental, like, basic, principle of everything that we do. And then, if we had to throw in one other person, I would say probably somebody like a Joel Greenblatt. He talks about using the market to your advantage. And a lot of that is, okay, there's all of these built-in, structural inefficiencies in the stock market that we are aware of, we know about, and it's how do you exploit them? And really what that just kind of means is, hey, let's go look at all of these things where we have a better, a larger probability of finding very mispriced things for all of these structural built-in reasons. Like, let's say a company gets deleted from the S&P index. So that means that the S&P index funds, they have to sell all of that stock regardless of price. You have all of this, artificial selling pressure, and with how passive the market is these days, like how large passive investing is, let's to word it better, that's a lot of artificial selling pressure. It has nothing to do with price. It has nothing to do with value. It's purely, this stock is no longer in the index, so we need to sell it, and we need to sell it now. So if you're looking at that, you can see these stocks go down, 15, 20, more than that percent. And it has nothing to do with the fundamentals. It has nothing to do with the value. So what does that mean? That means we should look at it. That doesn't mean it's going to be a good deal, but it means that we have a better chance of finding a good deal. He also talks a lot about looking at things that aren't well covered, things that don't have sell side research analysts covering them, some things that, are just maybe a little bit too confusing for most people to care about. Things that are smaller than most funds can invest in, basically just looking where other people aren't, because that's where, you may be able to find the biggest opportunities, the best opportunities, the biggest mispricings. But if you are able and willing to A, put in the work, and B, make your own, draw your own conclusions and make your own decisions. So that's what we try to do. I mean, a lot of what we do is looking at small caps, micro caps, spin-offs that aren't covered by the market yet, or that people don't even really know about yet, or that no sell side research analyst is covering. Just what are those areas of the market that we can go into that, larger funds that, funds that have very specific and defined investment strategies can't look at, that, where might we be one of the only people, or perhaps the most skilled people, evaluating what we're looking at? So I would say those are probably like the two. Those are the two that popped into my mind, at least. I mean, I'm not by name giving credit to the other 100+ people that I've in-depthly studied, but that's my answer.
Yeah. And okay, my other piece on this then is where have you, what in your perspective, like, why do people fail to beat out the market? And there's obviously an efficient market hypothesis for a reason. And when you look at long-term performance, and there's some funny quotes from even great investors who also fell victim to some of this, many of this hype that's happened over the course of time. But yeah, what's your take on where do people mess up and where do they go wrong?
It's hard to stay disciplined, when you see the same stocks going up day after day after day after day, and anybody with a brain knows that they're trading for 3, 4, 5 times what they should be trading for, but they go up every day. So at some point, some people break down. People who should know better, people who do know better, they can't resist the temptation. They can't resist watching people that they think they're smarter than make more money than they are. They can't, they hate going to cocktail parties and being like, hey, this doesn't make any sense. And people being like, you just lost it. There's all these reasons why people fail to stay disciplined. But at the end of the day, that's a lot of it. I mean, if you call yourself a value investor and then you're going and buying Tesla right now, you are risking getting caught on the wrong side of, a 70, 80, 90% price decline. And if you don't play hot potato better than anybody else, you're going to get smoked. And so, that's kind of the downfall of a lot of people. And I'm not going to pretend like it's easy. I mean, it's hard it's hard to resist that temptation, but you have to, in order to do this for 20, 25, 30 years and to not lose money to the extent that it takes you out of the game, to keep plodding along and making those good returns, I mean, you have to stay disciplined. And, I think a lot of people also, you have to work hard. Like, this has to be your life. This has to be what all you think about. If it's not all you think about, then that means there's somebody out there who's thinking about it more than you. And if somebody else is out there working harder than you, then that means they're probably doing better than you. So I think those two things combined are probably, at least for the people who kind of, understand the market, have done, who've done the proper learning, who have a good strategy. That's ultimately where the downfall is. I mean, we can also just talk about, there's just plenty of people who just have fundamentally flawed strategies. I mean, every year there's a new strategy that's supposed to be this new awesome, can't go wrong thing, and at the end of the day, like, the only strategy that really seems to work over time is buy things for less than they're worth. That's it. As soon as you stop buying things for less than they're worth, it doesn't go so well. It might go well for 2 years, it might go well for 3 years, it might go well for 6 years, but it's not going to go well for 40.
Mm-hmm. Mm-hmm. And okay, so today, right, we're basically earmarking, January 25 is like the formal launch of JNS Capital. You've alluded to a lot of it in what we've talked about thus far, but maybe if you could summarize it for us, how would you define JNS Capital in your words?
Again, I think that's actually pretty simple. I mean, it's been an evolution, but fundamentally, it's still the same thing it was years ago when I was just investing my own money. I mean, I started off investing my own money. Then I had some people notice that I was doing well, and they asked me to manage their money alongside my own in the same way that I manage my own money. And we had more family and friends pile on, so now it's my money, your money, our family's money, our friends' money, other investors who have trusted us. But at the end of the day, we're just managing everybody's money in the same way that we manage our own. And I'm not, I guess one way of putting it is we're not trying to take a bunch of risk in the hopes that we are incredibly rich in a year, right? Like, we're trying to maximize the probability that we are very wealthy in 40 years. And that's how we look at it. I mean, we've kind of already touched on our investing strategy. It's, we're incredibly downside oriented. Anything that we invest in, we want to make sure that, our downside is protected, that we're not going to lose, a considerable amount of money. And, in doing that, you inherently have a lot of upside. So we're just, we are trying to consistently make money, and, and we're trying to make sure our bad years aren't that bad. I mean, inevitably we're going to lose money in some years. It's just, it's a virtual inevitability. It hasn't happened yet, but it might. And we want to make sure that we're not losing 70%. We can lose 10% a year. That's fine. Yeah, that's totally fine. In fact, if your worst year is down 10%, you are incredible. And so that's kind of what we're trying to do. Like, we want our bad years to not be that bad, and we want our good years to be good. We don't need to make 300% in a year. And that's kind of the folly of a lot of people, is they take too much risk because they want to get rich fast. And all else equal, would I love to get rich fast? Sure, but I'm not going to risk everything, we've done so far in order to do that. So, I would say, I don't know, we like to throw around the term that, we invest like we're a family office, because that's kind of what we are in a sense. I mean, yeah, that would be my answer.
Yeah, and I think this space of money management, wealth management is very, very saturated. There's a lot of people, a lot of different institutions, firms, call it whatever you want, doing this and wanting to do it. What, like, for people that maybe have their money somewhere right now, or don't know where to put it, if assuming some of it's allocated towards the public markets. What can you kind of share from your perspective on the the other options in the money management world, and some of the things that kind of just rubbed you the wrong way, and because this wasn't, like, a lot of this was born out of the identifying a lot of issues in this space that we've talked a lot about. So can you talk a little bit about that? What are maybe the biggest ones that really irked you, and that you'd that really pissed you off?
I'm not sure that I would use the term pissed me off, but I think that, yeah, I mean, ultimately this was all created out of um, a lack of options that I thought were good. I mean, you've got as an investor, assuming you don't have $1 billion and can start your own family office, there's only so many places you can put your money. I mean, you've got the traditional wealth manager, and ultimately your wealth manager is not really an investor. They're more of a salesman or a relationship manager. So they're not actually making any investment decisions themselves. So you're paying them a fee, and they're essentially outsourcing the investing to other funds and other firms that are also charging a fee. So now you're paying double fees, and typically what happens is they put you in a mutual fund that deviates from the index just enough where they can sort of claim that they're actively managed and charge a higher fee, but really you're kind of just getting the S&P index, or you're getting the NASDAQ 100 index, or you're getting a pretty standard investment grade bond index. It's kind of a scam. And so you're basically paying double fees to get average results, and so your results are average minus fees. And it just doesn't really make sense, because if that's the route you want to go, you can just put yourself in index funds yourself and skip out on a lot of the fees. Now, especially in the current environment, the indexes aren't necessarily the route to go either. I mean, the S&P index is basically at, it's in something like the 98th percentile of its historical valuation range, which, it should be setting off alarm bells. And, the kind of standard thing you hear is, hey, just put your money in the index fund, just dollar cost average in, it only goes up over time. And, sometimes that's good advice. I mean, when the index is trading at reasonable valuations, sure, that makes sense. Why not? But right now, I don't think it's like, I really don't think it's a good idea. I mean, the valuations on the indexes are so high right now that you're either going to accept, you're likely going to accept either a pretty big correction or sell-off, or you're just going to accept a very long period of very low returns. I mean, let's think about like 2000. It took, if you invested at the peak of 2000, it took you something like until 2013, I believe, to even break even. So, just like anything, good advice is good until it isn't. I mean, let's look at something like in 2007, how home prices only went up. And so people took all of their disposable income and they bought homes. I mean, and that had worked for so long, but eventually it didn't. We all know what happened in '08. So it's just kind of that's another example of when things are, things that make sense until they don't. And where the indexes trade right now, I don't think you want to be indexed. There's a lot of phenomenal opportunities in individual stocks, but the indexes, in the index constituents are probably not where they're definitely not where I'd be investing my own money. And it's probably not where I would be advising people to put their money right now. So let's move on to another option, kind of like the last one we'll really talk about is like a more standard typical hedge fund. And, obviously there are exceptions to this generalization, but a lot of the time, what you'll see these hedge fund managers who don't really have a lot of money invested in their own fund, and they make money predominantly through performance fees, which means they make a lot of money when the fund goes up. But since they don't have a lot of their own capital invested in the fund, they don't really lose money when the fund goes down. So it kind of it has, I mean, it has a pretty not unaligned incentive structure whereby, a hedge fund manager is often incentivized to basically, well, lever up, take a bunch of risk. I mean, 6 out of 7 years the market goes up, so 6 out of 7 years levering up and taking a ton of risk is the right move for the manager. And then in the seventh year they blow up and their investors, lose money, but they walk away rich. And that didn't sit right with me either, because I'm like, okay, this is actually not a very good deal for the it's a great deal for the hedge fund managers, but it's not a very good deal for the investor. um, and so I feel like we've got that little happy medium where we have most of our own net worths invested in our fund. We've got, a very significant chunk of our family's net worth invested in our fund. We've got, a lot of our very close family and friends invested in this fund. And so we have absolutely no intention of taking a lot of risk, because 6 out of 7 years that works, but the seventh year we blow up. Because if we blow up, we lose all of our own money and our family's money and our friends' money. So, we are unique from, I would say, the broader hedge fund industry as a whole, in the sense that, we really are investing our partner's money in the exact same way that we're investing our own. And I think that removes a lot of the alignment of incentive issues I had with the hedge fund industry. I mean, we can get into more specifics about the industry, like how you attract AUM, which is basically outperform every quarter, or else, your money gets pulled. So what does that mean? That means managers chase momentum. They buy the things that are going up. Well, a lot of the times when you're buying the things that are going up, it means you're buying things that are very overvalued. And, I think you can look at the market today and you'll find some great examples where every single fund, that calls themselves a contrarian, they're in the same 7 to 10 stocks, which also happen to be the largest constituents of the S&P 500 index. And, well, I don't see that ending well. I don't see that ending well it'll end well for the managers, but it's not going to end well for the investors. So
That's like that if you think of the psychology there too, um, when there's pressure, if pressure is on getting returns, um, and it's not defined over what time period of returns, right? It's not really clearly articulated that it's a 10-year horizon. Then when the market's blowing up and everyone has a friend that is up, 60, 80, 100% year to date,
it gets pulled and it gets given to the guy who made 80% last year. So you got to have aligned investors, and I think, that's something that we've obviously talked a lot about. And fortunately we have, we've had a reasonable amount of success so far in our lives, and we're not in a position where we need to attract capital today or starve. We can be more selective about our LPs, and so we're able to find people that really align with what we're doing. And if we're managing over a 40, hopefully longer than that time horizon, we're going to underperform some years. And we're definitely, and we have a much higher, we have a much higher probability of underperforming in the years when the market's just going crazy to the upside, because we're going to sit a lot of that out, because we're not willing to risk our capital to chase the shiny things. And, oh, well, if the shiny things go up 100%, great. We're not going to be in it for the 80% collapse when the music stops. So we have investors that understand how it works. They know that sometimes we're going to lose money, sometimes we're going to underperform, sometimes we're going to overperform, sometimes we're going to make a lot of money, and it all just kind of, that's just how this business works when done correctly.
Mhm. Yeah.
And we're fortunate that we can take our time and actually build our LP base in a way that makes sense for us and our strategy.
Yeah, and maybe the last things I'll ask here, I want to kind of double click into that. Um, we spent a lot of time talking about this before, when we were ensuring that like we would have a good partnership and make sure we're aligned, but talking about how we want to grow and scale this business and what does that LP makeup look like. And I think um, it's very important to kind of communicate and emphasize what you said, where this isn't a like scale as fast as quickly as possible with as much money as we possibly can approach. We want to be extremely thoughtful and intentional with our LPs. So what, I don't know if you can maybe talk a little bit more about that. Like, what are the ideal? We have some LPs right now. Obviously, intention is to grow that and expand that. What's kind of the ideal LP that you sort of envision and think of, and kind of how do you envision that relationship being?
I definitely feel like so far the people that seem to align the most with us are, they're businessmen, they're entrepreneurs, they're investors. There are other ambitious, motivated people who tend to be successful in whatever field that they happen to be in. And, with business experience seems to come some, degree of investment acumen. They understand the deal. They understand how the market works, and, they're very aligned. And on top of that, I think one of the things that I've enjoyed the most about doing this is having LPs that really end up being kind of like our advisors and our mentors and people that we can go to for some industry knowledge. People, when we're
Totally.
looking at a company, we can go to one of our LPs and be like, "Hey, this is a competitor of yours, or this is the industry you're in. Like, can we talk about it?" And
Yeah.
they always want to. And, so I think kind of an interesting thing about how our partnership is working is we have all of these incredibly knowledgeable, successful people that kind of have a vested interest. I mean, they literally have a vested interest in our success, which really helps everybody else out. So it's kind of like it's a very interesting network effect that I didn't really foresee until we kind of were already going
Mhm.
and and moving. And it's been, I think, very rewarding for everybody involved. And I think people seem to really enjoy being a part of this, which makes me happy because
Yeah.
I didn't know that was a part of managing a fund.
Yeah.
Yeah, no, I love that. So I have maybe one of my last questions here. When you think 10, 20 years down the road, um, what assuming this is successful, right, which we have a confidence it will be, what does that look like? What does the success look like? And whatever that means to you, whether that's uh you know more performance focused, whether that's an AUM focused, whether that's open question, but what would success look like to you?
I mean, first off, we're in the business of making money, right?
Yeah.
So at the end of the day, success has to have some element of making money and,
Mhm.
and making money to a greater degree than our competition,
Yeah.
certainly. And, our competition is other managers and really kind of, the S&P index. I mean, at the end of the
Mhm.
day, like if common knowledge is, hey, put your money in the S&P index, then we need to
Yep.
be able to beat the S&P index over a long term, over a long time horizon in order to
Yeah.
be successful. So
So do you think about it as like a within a certain percentage range, net of fees year to year, or yeah, how is there a more specific layer, or just broadly, because things change year to year, beat out the competition?
I mean, I have my own goals for sure.
Yeah.
Goals that for regulatory reasons I can't really say. But
Hmm.
yeah, I intend to do everything I can to significantly outperform the S&P index, and you do too.
Yep.
And so, yeah, I mean, obviously, one very big element of success in my mind is crushing the indexes over a long time horizon, and
Right.
preferably with smaller drawdowns in bad years, which tends to align with our strategy. And if we can look back 40 years from now and be like, yes, we stayed disciplined, we executed our strategy, we didn't get swept away by shiny things whenever shiny things, started, became popular. I think we'll do very well. And I think that I think that if we can do that, then we will be very happy with the results. And the other side of it is I think we're kind of in a unique opportunity in this career where we actually can have a genuinely positive impact on people's lives. I mean, if we're successful, like we can fundamentally alter, people's, financial situation.
Totally.
And I think that that's kind of a very fulfilling aspect of this career.
Mhm.
And it's going to sound cheesy, of course, but I really do think the people that we meet along the way, the friends, the mentors, the advisors, all of the people we interact with along the way, not all of them, but the people that we enjoy interacting with along the way, the people we choose to partner with, the people we
Mhm.
choose to have in our network, I think that's an incredibly rewarding aspect of it. And I
Yeah.
think in my mind, that's something that I would consider a success is
Mhm.
just having all of these interesting, successful, unique people that I want to spend time with,
Mhm.
also wanting to be around us, contribute to what we're doing, spend time with us. I think that's very cool. And I've been
Yeah.
enjoying that aspect of this immensely so far.
Yeah, yeah, awesome, man. Right on. Well, there's a lot of there's there's a lot of layers deeper that I want to go on many of these topics, and we'll definitely get to them on some of the follow up kind of interviews that we do and share with people. We'll definitely go into you know definitely explore and discuss the current state of the market even more, because I think there's sure, I think overall a lot of people know that, yeah, crazy returns, it's inflated, but why, how inflated, how bad could the pop be, and a little more layers deeper into the context as to why. Also our strategy, right? I think this gave a good understanding of philosophically the background to it and so on, but deep value investing is very broad. We can talk a lot more about that. Special situations, there's a lot of different types of special situations. Small micro cap world. We also obviously have positions in the mid to large cap space as well. But yeah, just going, we're definitely going to go more in depth on some of those elements as well as case studies. I think there's some really cool case studies that we put together to illustrate how the approach, analysis, and so on was, which gives people even more of an understanding on how we approach things. So anyway, I just want to say thank you. I know this was, sharing all these different elements is time consuming, but I think this is really important. And I've learned a ton from you. I know our anybody listening, future LPs, anybody in our circle will continue to learn a lot, and very very excited to get this thing going. So anyway, appreciate your time, man, and excited to continue to do these.
That's great. Thanks for emceeing. Let's dive more into it.
Let's do it. All right, dude. Talk soon.
See ya.